Welcome to this ICMA webinar. I am Simone Utermarck, a Senior Director with ICMA's Sustainable Finance team. As we all have read in the news or might have experienced ourselves, extreme weather events are becoming more common due to climate change. And in the wake of severe weather events, especially developing countries often face painful trade-offs between the needed response, which requires, for example, rebuilding their communities, while still having to make debt repayments. Climate resilient debt clauses, or CRDCs, are a solution that allows debt services to be paused to provide breathing space when countries are hit by climate catastrophes, such as hurricanes, earthquakes, floods, and other disasters. CRDCs mitigate this risk by suspending debt service repayments for a pre-agreed period when a predefined climate shock hits. This frees up cash flow that could be better used to support disaster relief, acting as a form of disaster insurance for those facing the risk of severe liquidity problems. CRDCs were also a topic at COP28, and as not everyone might have heard of them, I am very pleased to be joined today by 3 experts to discuss this debt solution to a very important problem. Let me introduce them to you. First of all, we have Deborah Zandstra, partner at Clifford Chance. Then Edward Wilson, head of Debt and Development Finance Unit at Treasury. And last but not least, my colleague Leland Goss, General Counsel at ICMA. Welcome, everyone. So Lee, let me start with you. When we talk about climate-related debt instruments, we immediately think of green bonds, for which ICMA, of course, provides guidance in form of the green bond principles. However, while with green bonds, the focus is on raising finance for environmentally eligible projects, such as climate change mitigation and adaptation, including resilience, other solutions are needed for when disasters actually strike. Can you give us some examples and explain the differences between various instruments and tools?
Yes, CRDCs in bonds and loans are quite different from green bonds, but it also helps, I think, to reference an instrument that's been around for some time, which are cat bonds, which are an insurance product that give the investor basically insurance risk. And I think the key difference with cat bonds, they actually pay out when an event happens, like an earthquake or a hurricane. CRDCs, on the other hand, have a pause in the payments and don't excuse the debt. The debt is fully repaid at the end. I think it's also helpful to understand CRDCs in the context of other kinds of bonds that are linked to external events. Now, people would be very familiar, I would imagine, with inflation-linked bonds, which have been around a long time. We also have experimented with GDP-linked bonds, which exist on paper but not in practice. And last but not least, there are sustainability-linked bonds, which are they're objectively linked to a key performance indicator that can change the coupon payment depending upon whether a specified target is met.
Thank you for this brief overview. And Deborah, maybe let me get to you about the more technical parts. I was wondering, actually, with the CRDCs, it obviously needs to be determined that a disaster has happened or established. Who determines what counts as a disaster? And also, how do CRDCs actually work?
So the idea is that CRDCs will be embedded in a bond or a loan contract at the outset when the transaction is first entered into. And the terms and conditions will set out a description of the disaster event or deferral event and the related triggers, and also procedures for notifying the trustee or the facility agent, depending on whether it's a bond or a loan, that the debtor wishes to activate the debt deferral mechanism following the occurrence of a disaster event which is in scope under the instrument. So ideally, the clauses will work in such a way that bondholder or lender consent is not required following the occurrence of the disaster, but that if the sovereign wishes to use the mechanism, and it will be a discretion that the sovereign has to do so, there's a well-defined process in accordance with which it's expected to notify the trustee or the facility agent, and it will have to set out information as to the disaster that has occurred, and also that it meets the conditions for triggering the mechanism. And typically we expect that there be a confirmation from a third party. So in the Caribbean, examples we've seen and the term sheets we've developed in the context of Caribbean countries, the CRDCs have been linked to the Caribbean Catastrophe Risk Insurance Facility. And there's an expectation that the CRIF will confirm that an event has occurred, or a policy event, and that payments of a certain magnitude related to the magnitude of the disaster event are expected. Similarly, with the pandemic event that has been explored as well, that's linked to the World Health Organization, for example, declaring that a public health emergency of international concern with a phase 6 status has occurred. So there's a third-party element that gives commercial lenders and bondholders a transparent and timely, reliable and verifiable independent corroboration of the event and the magnitude of that event. And what is interesting to note is that in the context of bonds that are issued into the international capital markets, or loans that have a syndicate, say, of commercial lenders, there's a need to be more granular as to the trigger and the magnitude of the event than maybe might be the case in instruments which official bilateral lenders or multilateral development banks may agree to introduce these mechanisms in those instruments, because there's the ability to have more of a dialogue between the debtor country where it faces such as an exogenous event and its counterparty, whilst if you're issuing bonds into the capital markets, of course, you can do a consent solicitation process and so forth, but that might delay things. So we need to drill down into more granularity. But I mean, just to say very, very briefly, these are meant to be mechanisms that provide a breathing space. They're meant to just be one risk management tool that countries can use. It's not meant to replace countries looking at insurance or multilateral development bank emergency support, or indeed the need to take actions that prevent actual disasters and build resilience in the country. And these mechanisms are also not meant to be a sovereign debt restructuring regime as such. They're just there, as you mentioned, to provide a liquidity buffer. And then if further down the line, debt sustainability cannot be maintained without conversations about a restructuring, then the idea is that these instruments will just rank pari passu with other debt that maybe doesn't include these mechanisms.
And just a follow-up question, I guess. I was wondering, how long is it paused? Is that predefined in the clause, or does that depend on the severity of the disaster? Can you give us a bit of an idea as to how long the debt is paused?
So I think again, just to say, the work that has been done by all of us on this call has led to the publication of template term sheets and proposed trigger language and so forth. But we do think that what the debtor country and its dealer managers or arrangers think is fit for purpose in the context of its own debt management should really be the driver of some of the detail. But I think the idea is that the debt service deferral looks to be of a 1 or 2 year duration, and that the amounts that are deferred are added by way of increase in principal amounts payable at the end, although this could be on a pro rata or on an amortization basis. And you also have to give some thought to, is there a limit of how many deferrals you can utilize? So, we really were able to discuss this in a live scenario during COVID, because you could have seen a situation where a country, a small island nation, suffered a hurricane, but then COVID happened. And so, here you have two completely different exogenous events that might still be, key to providing some debt service suspension needs. And so do you allow each one of these events to be triggered at least once? So these things are set out in the work that has been done for discussion, and then it will be up to the ministers in the debtor country concerned and its banks and advisors to evaluate how to structure the actual triggers.
And just to add, I think financially the intention is that the debt is fully repaid by the maturity date, so that the end maturity date does not extend, but it's heavier payments in the back end, hopefully after the impact of the disaster has passed or been mitigated. And I think it's right that the intention is that these are as much as possible to be NPV neutral. Is that your understanding?
Yes.
Thank you both. That's very interesting, but certainly it sounds like it's not an easy task to evaluate that or pre-evaluate that. Ed, let me come to you. In 2021, the UK established the Private Sector Working Group. Chaired by HM Treasury, the group brings together international financial institutions, including the International Monetary Fund, IMF, and the World Bank Group. G7 and borrowing countries are also part of it, and the private sector, including major US and European banks, as well as investment firms, legal and financial advisors specializing in sovereign debt, as well as academic experts. One of the key areas of focus has been climate resilient debt clauses. What progress has been made by the working group?
Thanks, Simone. Yeah, it's a good question, and maybe it helps to give a little bit of background on the group and how it came about. So this was a group that we set up in the UK at the time of our G7 presidency in 2021. And as you say, there were a wide range of stakeholders across the private sector, including the international financial institutions, the official sector, borrowing countries, and Deborah and Lee here, for example, were part of that group. And the idea was for it to be a wide and representative group who could, really think through these issues. And I think we were setting that group up in response to a number of dynamics. Now, we had one work stream, which was actually about the syndicated loan market and developing majority voting provisions. And actually, you could do another podcast on that because it's a very interesting topic. But in this case, the other sort of dynamic we were responding to with the group was these sort of growing calls to address this kind of nexus between climate change and debt issues, and where there was sort of growing awareness that many countries, especially vulnerable lower income and small island states, were facing increasing risks and increasing prevalence of severe weather events and natural disasters, and that could obviously impact on their ability to repay their debts in the aftermath of a disaster. So, as Lee and Deborah both sort of said, when a country is facing a disaster like that, what we don't want is large debt repayments getting in the way of their disaster relief. And so the idea was, to sort of work together to, build on work that had already been done actually by colleagues here and Canadian sort of colleagues on looking at clauses around hurricanes in the Caribbean, and which had sort of been inserted in some restructured bonds of Barbados and Grenada, but sort of broaden that out and create a standardized term sheet with market buy-in, and that could be used by a range of countries for a range of different disasters. And so the work sort of focused on that and working through the different issues that might be involved with including these sort of clauses in debt contracts. And so the sort of progress of the group, well, as Deborah sort of alluded to, we worked up a standardized term sheet, which built on the previous work by the IMF, ICMA, Clifford Chance, under the Canadian presidency of the G7. And we produced a chair's summary, which set out like all the sort of things we discussed in this group, all the different sort of parameters, like issues like ratings, regulatory issues, and pricing. So I think, which was kind of helpful to show that those discussions had happened and what the conclusions of, you know, important sort of investors and banks and people involved in these sort of contracts and contractual arrangements thought on all those issues. And we sort of set out this standardized term sheet. And, you know, this was all announced at COP27 in Egypt in 2022. And the UK was very proud to have sort of sponsored this collaborative work, working very closely with Clifford Chance from the legal perspective and involving experts like Lee.
And you just mentioned COP27. I earlier already mentioned COP28. And I saw in the run-up to COP28 that in June 2023, the UK and Barbados, together with Ghana, France, the US, and Spain, launched a call for bilateral, multilateral, and private sector creditors to offer CRDCs, climate resilient debt clauses, by the end of 2025, with a group of early movers offering the clauses by COP28, so that borrowing nations have the necessary fiscal room to respond fully to shocks. Can you give us a few more practical examples? You already mentioned a few things perhaps related to what I just laid out and what happened at COP28.
Yeah,
as well, if you want to.
Shall I come in first? Yeah, so at the sort of Macron summit in June, we, along with a number of other countries, launched this call to action. And the idea was to galvanize all creditors to begin offering these clauses. And now at COP28, we've extended that so that we have 73 countries now calling for this action. And that includes a group of countries called the V20. It's called V20, but I think there's something like over 60 countries, vulnerable countries to climate change, who are now pressing and calling for this. And you see a lot of calls from you know, prominent people in the global south, like President Mia Mottley of Barbados, who's been a very vocal advocate for these clauses and taking action. And I think we were really pleased that at COP28, we've seen a sort of growing list of lenders, bilateral lenders and multilateral lenders primarily. And I think we'll come on to the question of private lenders, which was where this work originated. But we are now seeing a growing list of bilateral lenders and multilateral lenders. So we've got, along with the UK and our UK Export Finance department here in the UK, we've got France, both its Treasury and the AFD, which is the development sort of agency in France, offering these clauses, Canada offering these clauses, and the US, Germany, and Spain all announcing they're exploring them very actively. And we know from bilateral contacts that we have other bilateral countries looking at this as well. And then on the MDB side, we've got the World Bank and the IADB. And the IADB has been a pioneer in this area, and they've been offering these clauses for some time. And then since COP28, we've also got the EBRD, the EIB, and the African Development Bank all sort of planning to introduce these clauses this year. So I think it's great progress being made, actually, and it's really pleasing to see.
That's very, very impressive progress, and we're very grateful to the official sector in the UK and others for leading this. the goal here is to spread these as far as possible. And I think, with that positive aspect, there's also challenges ahead. And I think the first and foremost one is trying to get this into the private sector, which has not really happened, with the exception, I think, of one or two restructuring exchange offers where these terms were put into the exchange bonds. But that is easier to do in the context of restructuring, because the dynamics are very different from new money financing. Equally, there's more flexibility with official lending to put these in, but it's a taller order to sell these to asset managers, institutions, pension funds, insurance investors, et cetera, et cetera. But that would be a great way to really scale up the prevalence of these, which of course benefits these particular borrowers. And I think that raises a number of other questions. Is how do we entice a first mover issuer to do one of these bonds? It's yet to happen as far as new money finance. And it also raises a question whether this will entail some sort of investor premium over an ordinary government bond, which could be a bit of a detraction from an issuer standpoint, obviously. The other thing is that when we speak with some of these eligible borrowers, particularly in the Caribbean region, they make the point that the debt relief is helpful, but it's not as helpful necessarily as having fresh cash at the time of a disaster. And some of these countries have accounting rules that don't allow them, if they suspend the debt service burden, that doesn't allow them to then allocate the payment that they would have made to other things like buying emergency supplies and that sort. So, I think it's going to be sort of a case-by-case question of how useful or how well utilized the debt relief will be for some borrowers versus others. And I think the last thing, and I'll defer to Deborah on this, is people are going to ask, is there going to be a rating impact either at the time of issue or on the triggering of an event from a hurricane or an earthquake?
I mean, I think the way that we've structured our thoughts on this work is to try and make the inclusion of these provisions as neutral, a little bit like aggregated collective action clauses, although they're quite different. But the thinking being in particular that if you have a country that has one of these exogenous events and really can't meet humanitarian needs, the likelihood of that country defaulting has increased exponentially. And at least with these mechanisms, you give the country a bit of a liquidity buffer to hopefully, subject to the accounting issues that you've just highlighted, be able to repurpose some of the fiscal savings for the provision of relief to civil society. So the rating agencies, I think, also look at them in that way, and in particular because there's no actual haircuts or debt relief as in terms of principal reduction and so forth being given. It does hopefully create a sort of mechanism which will not cost additional amounts to countries that are looking to build in these protections. But you're quite right, Lee, it's only just one tool among many, and they may very well need to look at their risk management profile as it relates to climate change and so forth in a more holistic way, and this is just one of those elements. I think the other shortcoming at the moment is that the triggers that we've seen used are very much linked to the CRIF, which I mentioned, the Caribbean Catastrophe Risk Facility, and that it comes with its own sort of mechanisms in terms of payouts and so forth, which by linking to that facility, you are in some way embedding also in these contractual arrangements. And so I think that the thinking needs to move a little bit beyond that regionally, so we can create templates that can work in other regions of the world, not just the Caribbean. In terms of triggers, can we move to other events that are not just earthquakes or tropical cyclones, hurricanes, and severe rainfall events? And also, can we move beyond these anchors in risk pool facilities? And so we do have a group at the moment, a multi-stakeholder group that has really sort of expanded the constituency of participants, but is still reflective of the group that Ed in the UK had convened under the UK G7 presidency. To look at these additional elements. And hopefully once more work has been done and the ecosystem of CRDCs has continued to expand in the multilateral and official bilateral space, we can start to mobilize interest in including these instruments in capital market, new debt issuances, and not just debt for nature swaps or the exit instruments in debt exchanges, which Lee was referring to.
Thank you very much. That's very interesting. And Ed, of course, mentioned Miyamoto. She was one of the very vocal ones at one of the COPs. And we just saw also last year that Barbados funded its first pioneering climate resilient debt clause bond. So I'm sure we'll see more in this space. Presumably there's going to be more talk about this at COP29 as well. Ed, we might as well do a second podcast or webcast then. In the meantime, thank you very much, Deborah, Ed, and Lee, for your insights into climate resilient debt clauses. Thank you.
Thank you very much.